what happened?
She left so that she could restart it.
Never mind. Sorry. Can you hear me now?
No.
Damn it. I'm just like feeding into that USD drinking game today. Sorry about that.
What?
Sorry, I had to say it. So one of my friends works at USD, and apparently there is like a drinking game that the USD students are playing. If their teacher has a technology issue, they're taking a drink.
Drinking bingo too.
Oh, awesome. So there's all these things that I've never heard.
Oh my God.
But don't worry, we would never.
Hey, if we had this kind of pandemic thing happen where I was in college, we would not have class, period. There was no such thing as Zoom back then.
Can we play that right now? Question mark.
No.
Hi, Trevor. I like that it came up on you right when you were like taking a sip. That's awesome. So,
as long as you're above age.
If you're above age, take a drink.
Above age.
I am not condoning underage drinking.
Oh my God, that was wild.
And I didn't see that. That was a Diet Coke. We're good. Okay.
Yeah. Mountains are blue.
Oh, man.
Okay, sorry. Thank you guys for bringing humor to me. Thank you. I appreciate it. So what I was saying was sales revenue, variable expenses, and contribution margin. You can also put it on a ratio basis. And if you remember from financial accounting, you did vertical analysis in like one of your last chapters. Anybody? Vertical analysis, like a vertical line straight up and down, right?
Yes.
In the income statement, what we were doing was we were putting every single number in the income statement as a percentage of sales. That was our base. So in this analysis, and when we're calculating ratios, we're still going to put it as a percentage of sales, but we're only going to put sales, variable expenses, and contribution margin as a ratio. We're not going to put fixed expenses or operating income as a ratio because we know that those change. If changes in sales level change, it's going to change. But the ratio for sales revenue, variable expenses, and then contribution margin are going to remain constant unless we change the selling price per unit, or if we change variable expenses per unit, that's also going to change those ratios. So I'm going to show you two ways to calculate each of them because in some situations you're going to be given one set of information and not the other. So you need to know how to do it both ways. So I'll erase this. This is taking way longer than usual. Sorry.
Professor, you have, what kind of computer do you have, you said?
Surface Pro. It's the Microsoft one.
I already
They have
knew
this OneNote. It's like I don't know, it's amazing. And I have a former student to thank for it because he told me he had it in class and I saw it. I'm like, this is amazing. So sales revenue as a percentage. You can take total sales divided by total sales, or the selling price per unit. I just needed to make some space, sorry. Or we can take the selling price per unit divided by the selling price per unit. So you can do it on a per unit basis, or you can do it in total. Either works, and it's going to calculate the same. I'm just going to erase. So in this case, you would take the 250 divided by 250,000. And that equals, as a percentage, 100%. Sales as a percentage of sales equals 100%. It always will equal 100%. That's a guarantee. If I was to use the per unit, so the selling price per unit, 500 per unit divided by 500 per unit, it's also going to calculate the same to 100%. Sales as a percentage of sales always will equal 100%. It's a guaranteed thing. You don't even have to calculate it. For variable expenses, this is our variable expense ratio. Or variable cost ratio. So what percentage of sales are our variable expenses? So you can take your total variable expenses divided by total sales.
75%.
Or you can take your variable expense or variable costs per unit divided by the selling price per unit. So for every unit sold, what percentage of that sale is variable expenses? What percentage of that sale do you have that's variable expenses? So we're going to take the 150,000 divided by 250,000. And that equals what percentage?
60%.
60%. So for every $1 of sales, 60 cents of that dollar is going to variable expenses. And I could do the same thing with the variable expense per unit. So $300 per unit divided by the selling price per unit, $500 per unit. And it also equals 60%. I'm showing you both calculations because you're not always given the per unit information. You're not always given the total information. You need to know how to calculate it both directions.
Are you all done?
Professor, wait, I have a question. If, for example, you have, like, I don't know, like you're trying to forecast the variable cost, will you take a horizontal analysis and take a 3-year average weighted difference?
Are you trying to say it from like the financial statements, like from external financial statements?
Yeah.
So it's hard to get the variable costs. It's hard to know what the total variable costs are. You're going to make a huge assumption saying that cost of goods sold is variable, 100% variable in nature, unless it's not a manufacturer. If it's a merchandising company, then you can pretty much assume that it's variable, the cost of goods sold is variable. But it would be very hard to find the variable expenses in the operating expenses because that's not how we break it out externally.
So
there's a reason why a lot of publicly traded companies do not use the contribution income statement for internal decision-making purposes. because they would have to disclose this to their competitors in their financial statements,
Makes sense.
and they don't want to. This is extremely sensitive information. You don't want your competitors to know that for every $1 of sales that you make, 60 cents of that sale is variable expenses. That's a high variable expense ratio. You have a lot of variable costs. For the contribution margin, this is the great part. Just like with the per unit, you can subtract down. So I know that if my variable expense ratio is 60%, then my contribution margin ratio by default is 40%. So for every $1 of sale, $0.40 of that dollar goes towards covering my fixed expenses and adding to my bottom line. And there is a calculation. It is the same type of calculation as the other ones. Damn. So the contribution margin ratio equals total contribution margin divided by total sales, or contribution margin per unit sorry, we're going to take a 10 or let's say 5-minute break. I'm going to restart my computer and then come back. Yes? Does everybody hear me? No?